So today I'm here with Vincent Newsome from National Mortgage Funding to answer all of your questions.
Thank you, Leslie. Great to be here.
So one question that we received a few times is, what is a home equity loan?
It's a great question. There's two different types of home equity loans. There's a home equity line of credit or a home equity refinance. What that means is you are pulling cash out of your house in both scenarios. One scenario on a home equity line of credit, you're looking at almost like a draw. So you can draw from the house and whatever you draw is what you pay on. Typically, those are interest-only products. A home equity loan is a refinance where you actually pull money out from the house and that's on a fixed rate. A little bit more secure and you can always refinance that down the road.
Great. All right, so another question we received is, do you have to have 20% down to purchase a home?
We get this question a lot. So there are options where you can't put 20% down. What that does, that avoids what we call as mortgage insurance. That's a monthly fee that the lender charges because they do not have 20%, almost like a risk assessment. You do not have to put 20% down though. We have options if you're a first-time home buyer that you could put as little as 3%. There's programs like FHA where you could do 3.5%. There's programs of VA where you can do 0%. So there are different options that you can do. Now, if you're not a first-time home buyer, the minimum down payment on a conventional loan will be 5% down typically. Now, the reason that people decide not to do 20% down and will go with a lesser amount is because mortgage insurance now is not as expensive as it used to be. So when you do the math on how much you're applying compared to how much you're paying on mortgage insurance, that break even is usually a lot longer than what you'd expect, and it makes more sense to keep your cash. Now, if you're planning to do 20% to begin with, that's a good investment, not a bad plan. Go ahead and do that. But if you're struggling to do 20%, there are options where you do not have to.
Great. So another question that we received, and we actually received this one a few times, how does the appraisal affect the purchase price?
So the appraisal comes into the mortgage process in a couple different ways. If it comes in higher, that's awesome news. Your mortgage will stay the same. You walk into the house purchasing it with equity right off the bat. Now, if the appraisal comes in lower, then we need you to step in as an advocate for the buyer to renegotiate the contract to hopefully lower the purchase price to match that appraisal value. That way, now you're getting a little bit better of a deal than what you were expecting, and you still get to purchase a home. Again, if the appraisal comes in higher though, no change on the contract, we get to move forward, everyone's happy.
Yeah, and I think it's important when you're speaking with your clients to set those expectations in the beginning before even writing a contract, to know that that could be a case and what to expect when it happens. So, good partnership. So we received a couple questions on VA loans. Does it still require a pest inspection, and is it really 0% down?
So at recent changes in Michigan, VA loans do not require pest inspections anymore. They used to. Now, the only time a pest inspection would get flagged is if the appraisal comes in and the appraiser notates damage. Then the VA could come back and say, okay, we want this house to have a pest inspection. But from the start, there is no pest inspection that's required. Now, as to 0% down, I personally get this question a lot. What that means is 0% down is zero equity towards the loan, which is great. But there are still other fees involved: title work, homeowners insurance, property taxes, your appraisal fee. There are different expenses when it comes to the VA program itself, just like any other loan. But the benefit of that, again, is that you don't have to put any money towards the actual mortgage. So if you're doing a $100,000 mortgage, you can do, or $100,000 purchase price, you can do a $100,000 mortgage.
Great, thank you. All right, and finally, we received a couple questions regarding escrow. Is it required? What's included in it? And what does it really mean?
Escrows are your property taxes and your homeowner's insurance. What that is it's an account, almost like a savings account, that you personally don't have access to, but the mortgage company does. Every time you make a mortgage payment, your property taxes and your homeowner's insurance are part of the payment along with principal and interest. Now, the property taxes and homeowner's insurance go into a separate account, which is that escrow account that the mortgage company holds. And when your taxes come due, they pull from that account and they pay your property taxes. When your insurance is due, they pull from that account and pay your homeowner's insurance. Now, if there's a shortage in that escrow account, so that means, let's say, your taxes went up and they weren't collecting enough, they are going to come to you and ask you for that difference. Now, what that does is that raises your monthly payment. you'll have an option. You can either catch it up by paying a big lump sum and then pay that difference per month, or they'll make your payment per month larger to make up for that difference in the escrow account. Now, ways to, I wouldn't say avoid, because a lot of the times you can't avoid that, but ways to prepare for that is to make sure that you are looking at your property taxes for the following year. That's where your real estate agent and I would come into play to make sure that we're not only looking at the taxes currently for your monthly payment to make sure that's comfortable, but we're also looking at what it's going to be next year when it gets reassessed and the state gives you an estimated value and your taxes do increase, that you're prepared either for the monthly payment, or we're telling you how much money you need to save per month to make up for that lump sum difference, so it's not as big of a payment shock the following year. Now, are escrows required? Yes and no. It depends on the lender that we go through. Most lenders, though, they are not required. Now, if they are required, there are certain instances where you can bring your loan size down, so bring more down to make up for that escrow, and they won't make you have an escrow account. But for simplicity's sake, I would say no, escrows are not required. So if you do decide not to pay your taxes and insurance within your mortgage payment, then you are only going to be paying the mortgage company principal and interest. What does that mean for you? Well, in the state of Michigan, most counties, cities, and townships, you pay taxes twice a year. So you have a winter tax and a summer tax. So if you decide to pay that separately, you want to be prepared to pay lump sums in December and in June. For homeowners insurance, depending on your policy, you will pay that once a year, and that's usually the birth date of when you purchased your house.
Great. And I know from myself personally, the second year taxes is something that I dealt with. So we always make sure that we're talking to our clients about that so they're prepared for year two when there is an increase, especially if they're buying from an owner that's owned the house for quite a while. We want to make sure that they're mindful of that so they're financially set up for success. So, Vincent, thank you for stopping by and answering our questions. If you happen to have any other questions you'd like Vincent to answer, you can reach out to him directly at.
So you can find me on all socials, Facebook, Instagram. Definitely call me 248-388-5528. Thanks for having me.